Welcome to Voyage Daily Tech, the most important news personalized for you every day, supported by Voyage.com.
Today we're sharing 5 stories. First, we'll look at Meta's massive $70 billion gamble on new smart glasses. They come with a wristband that reads your muscle signals to control them with just gestures. Second, the AI giant Databricks is on a shopping spree, acquiring the $900 million startup Tecton, a move that steals a key partner directly from its biggest rival, Snowflake. Third, a disturbing new trend where AI-generated fake albums are being released under real artist names on Spotify. We'll hear from musician Emily Portman about her creepy digital doppelganger. Fourth, President Trump calls himself a fan of TikTok and signals another delay for the forced sale, a direct contradiction of the law he signed and national security warnings. And fifth, how a few words from Fed Chair Jerome Powell triggered a massive crypto surge, wiping out $120 million in bets against Ether in just 1 hour. The story begins with a decision that caught everyone by surprise. Meta is about to launch smart glasses that come with a wristband designed to read the electrical signals from your muscles, allowing you to control them with just hand gestures. So the thing is, that wristband uses something called surface electromyography, or SEMG. This is a huge bet by Meta because competitors like Apple are using cameras to track your hand movements. Meta's approach avoids cameras entirely, which means better privacy and lower power consumption, but it's a totally new way for us to interact with computers. It's a fundamental choice about the future of input. The company is rolling out its first consumer-ready glasses with a display, codenamed Hypernova, but this isn't just a tech play. They're being sold in partnership with Essilor Luxottica, the fashion giant that owns Ray-Ban and licenses brands like Prada. The glasses are expected to have thick frames, potentially making high-fashion brands a suitable fit. And this partnership is deeper than it looks on the surface. It's not just a branding deal. Meta recently took a nearly 3% stake in Essilor Luxottica, an investment worth around 3 billion euros. This shows they are completely intertwined, betting that the future of wearables isn't just about function, but about high fashion. But that's not the whole picture. The real turning point is the staggering gamble behind this launch. Meta's hardware division, Reality Labs, has burned through nearly $70 billion in losses trying to build this future. This new device is their next big swing to make that spending pay off. The technology is straight out of science fiction. The wristband, built by a company Meta acquired called Control Labs, uses SEMG sensor technology to interpret the neural signals controlling your hand, turning them into commands for the glasses. It's an attempt to create a new interface for computing without cameras tracking your every move. The stakes are incredibly high here because when a device reads your neural signals, it's collecting a new, incredibly sensitive class of biometric data. This data could, in theory, reveal information about your health, your emotions, or even intentions. In reality, the law is racing to catch up. For example, California recently updated its Privacy Act to specifically include neural data, but there are no uniform rules yet. This is a huge open question hanging over the technology. There is, however, a significant hurdle. The Hypernova glasses are expected to cost around $800. When we place Meta's strategy alongside Apple's, the contradiction becomes clear. The Vision Pro launched at $3,500. Meta is taking a completely different path. Instead of going big with the most advanced tech, they're launching a more limited, more affordable device. It's a pragmatic play to get these glasses into more hands, gather data, and build a market incrementally, hoping to win mainstream adoption through accessibility. And according to people familiar with its development, that futuristic wristband has run into challenges. If it's worn too loosely, it can't read the signals properly. It has also faced issues in testing on different arm sizes and even with users who wear long sleeves. Despite this, Meta is pushing ahead, hoping to get developers excited to build apps for the new platform. So you might be wondering, what could a developer even build for such a limited display? The key is thinking beyond social media. Think about glanceable, essential information. In logistics, companies like DHL saw a 25% jump in efficiency using similar head-mounted displays for workers. The killer app might not be a game, but something like real-time navigation or hands-free instructions that keep you in the moment. Sales of their previous, simpler smart glasses have already tripled year over year, proving there's an appetite It all leads to the big question. After losing $70 billion, are gesture-controlled glasses the breakthrough that finally makes the metaverse a reality? Or is this just the next chapter in one of the most expensive experiments in tech history? Speaking of massive tech gambles, the software world saw its own high-stakes power play this week. A company's value just exploded by more than 60% in only 8 months, rocketing past a $100 billion valuation. And now they're on a shopping spree. That company is the AI giant Databricks, and they just announced they're acquiring the machine learning startup Tecton. While the exact price is under wraps, Tecton was last valued at a staggering $900 million, backed by top-tier investors like Sequoia Capital and Andreessen Horowitz. To understand this move, you have to look at the team behind Tecton. They actually came from Uber, where they built the pioneering AI platform called Michelangelo. So Databricks isn't just buying code, they're acqui-hiring a team that has already solved the problem of real-time AI at a massive global scale. This is where the situation takes a more complex turn. Tecton wasn't just working with Databricks, they were also partnered with Databricks' biggest competitor, Snowflake. In a stunning power play, Databricks isn't just buying a new technology, it's buying a key partner right out from under its rival. This acquisition creates a huge dilemma for Snowflake and its customers. For years, companies using Snowflake's data cloud could integrate Tecton's tools to build their machine learning applications. Now, that critical technology is owned by their chief competitor. This highlights a huge risk in the tech world called competition, collaborating with a competitor, and the fallout can be severe. So, what's the prize that's worth sparking a war in the data world? It all comes down to one thing: speed. Tecton is all about real-time data for AI agents. The biggest challenge in making AI feel smart and responsive is latency, the delay in getting live up to the second data to the AI model. Tecton solved this with something called a feature store. Think of it as a highly organized, super fast pantry for AI. It ensures that the data an AI model was trained on is perfectly consistent with the live data it uses to make real-time decisions. This eliminates errors and, most importantly, lag. As the Databricks CEO put it bluntly, the goal is to cut response times in AI applications because, in his words, humans hate to wait. This is a direct shot at building AI that feels instantaneous, and this is just the latest move in an aggressive acquisition blitz. However, if you zoom out, you'll see another layer of strategy at play. Databricks has been systematically buying the building blocks for an AI empire, dropping $1.3 billion for Mosaic ML, over $1 billion for Tabular, and another $1 billion for the database company Neon. Each purchase has a specific purpose. Mosaic ML is for building generative AI models. Tabular is for organizing massive data sets. And Neon is for serverless databases. Now, with Tecton for speed, they are assembling an all-in-one end-to-end AI platform. The strategy is to offer customers a single integrated ecosystem for everything AI, which could lead to what's known as vendor lock-in. They're using their soaring private valuation to snap up critical startups, building a comprehensive platform piece by piece. It leaves us wondering, what is Databricks' final endgame and who will be left standing when the dust settles? We've been talking about the high-stakes billion-dollar world of AI development, but there's a much darker, creepier side to this technology that's now hitting the music industry. A seemingly impossible situation became a reality for folk singer Emily Portman. A fan congratulated her on a new album. The only problem? She never made it. She discovered a full album called Orca, released under her name on Spotify and iTunes. It wasn't her. It was an AI-generated fake with a voice cleverly trained on her own, a detail she found really creepy. A few days later, another fake album appeared, which she dismissed as 20 tracks of instrumental drivel and just AI slop. This is more insidious than a simple copy. You see, these AI models are trained on an artist's entire public catalogue, learning every nuance of their vocal delivery. And the reason this is so difficult to fight is that while copyright law protects a specific song, it doesn't traditionally protect the unique style or sound of a voice. This creates a dangerous legal grey zone that these impersonators are now exploiting. And she's not alone. This is a new front in the AI war targeting real artists. Josh Kaufman, a musician who played on Taylor Swift's Folklore, album found a bizarre computer-generated track released under his name. He called the experience embarrassing and confusing, saying, "This is the signature of our soul," and that someone else can walk in there and just have access like that. The fallout goes beyond just one confusing track. Experts call this the problem of digital doppelgangers. When AI-generated slop is released under an artist's name, it can dilute their brand and erode the trust they've built with their fans for years. It devalues their entire authentic back catalogue by mixing genuine art with cheap machine-made fakes. What really brought this to a head was the next development. A new song recently appeared on the official page of country singer Blaze Foley. The shocking part, Blaze Foley died in 1989. This kind of posthumous digital puppetry exploits an artist's legacy without any recourse. It's a direct challenge to what's known as the right of publicity, the right for a person to control the commercial use of their own name, image, and voice. In response to this exact problem, Tennessee recently passed the Elvis Act, a groundbreaking law that makes it illegal to use AI to mimic an artist's voice without permission. But that's just one state, and a federal solution is still being debated. So who's doing this and why? The money is bafflingly small. One of the fake albums earned less than $6 per track in royalties. That $6 figure is deceptive though. The motive isn't one big score, it's a strategy of micro-fraud at a massive scale. Researchers call it a long-tail scam. Fraudsters upload thousands of these AI tracks across hundreds of niche artists and then use bots or streaming farms to generate millions of tiny fake plays. Each stream earns a fraction of a cent, but when multiplied, it siphons millions of dollars from the royalty pool that should be going to real artists. One industry report estimates that at least 10% of all global music streams are fraudulent, costing the industry $2 billion a year. The attacks seem to be targeting mid-level artists, perhaps to fly under the radar of the superstars. One name, Zayn Malik Mahardika, has been linked as a songwriter to fakes across multiple genres, from folk to Christian rock to metalcore. But the real enemy remains a ghost in the machine. For the artists, it's a battle for their identity. Portman says the experience feels like the start of something pretty dystopian. While Spotify eventually removed the content, she says it was a slow process that highlights a lack of protection. Behind the scenes, a hidden technological arms race is already underway. Platforms are now using their own AI to fight back. Some are embedding an inaudible audio watermark into AI-generated tracks, like a digital fingerprint that can't be easily removed. Google's version is called Synth ID, and Meta's is Audio Seal. These systems can spot a fake even if it's been sped up or compressed. It's a constant battle with fraudsters trying to erase the watermarks as fast as the platforms can create them. As these AI imposters flood streaming platforms, Portman is now recording her first real solo album in 10 years. The cost to create genuine human art will be at least £10,000. For musicians already squeezed by the streaming economy, she says this latest violation feels like a very low blow. Speaking of platforms struggling with difficult content, the battle over TikTok's future in the US just took another unexpected turn. Believe it or not, just days after the White House itself launched an official TikTok account, President Trump signaled he might once again delay the forced sale of the app. This all stems from a 2024 law passed with bipartisan support demanding that TikTok's parent company, ByteDance, sell its US assets or face a total ban. The original deadline was January 19th. Trump already pushed it once to September 17th, and now he's considering another extension, saying, until the complexity of things work out, we just extend a little bit longer. Now, that word complexity is doing a lot of work here. Separating TikTok's US operations from its parent company ByteDance is a technical nightmare. The core of the app, its secret source recommendation algorithm, is deeply tangled with ByteDance's global code. And here's the kicker. China has export control laws that classify that exact kind of algorithm as a restricted technology, meaning they might not even allow it to be sold. So creating a truly separate US version could take over 1 year and might not even work as well. But the rabbit hole goes deeper. When reporters asked the president about the very national security concerns that drove the law in the first place, he dismissed them, calling the issue highly overrated. And those security concerns aren't just theoretical. Research has shown that sensitive user data, including financial information, has been stored on servers in China that are accessible to ByteDance employees. A former executive has even alleged that the Chinese Communist Party used special access to monitor activists on the platform. So there are two distinct risks here: data harvesting and the potential for algorithmic influence to shape what Americans see. And then came the bombshell quote. His direct words on the platform he was supposed to be reigning in: "I'm a fan of TikTok." Now, get this. This isn't just a casual comment. It's a window into a massive political calculation. There are over 170 million American users on TikTok, a huge number of them young voters. It's also been reported that Trump met with major Republican donor Jeff Yass, whose investment firm has a massive stake in ByteDance. So you have a powerful combination of voter outreach and potential donor influence at play. This statement puts the administration in direct conflict with lawmakers who argue the repeated delays are flouting the law and ignoring critical security risks. If that was just the appetizer, the main course is just being served. Trump added another layer of intrigue, claiming, quote, "We have very substantial American buyers that want to buy it," but he refused to name any individuals or companies. This refusal to name names actually creates a huge problem for any potential buyer. The valuation of TikTok's US assets is all over the place, swinging between $20 and $50 billion, depending on whether that secret algorithm is included. This constant instability makes it incredibly difficult for a normal company to make a strategic bid, and some experts suggest it creates an environment where only politically connected bidders can navigate the chaos. So the question now is, a law demands a sale, lawmakers are sounding the alarm, but the White House is now on the platform, and the president calls himself a fan. What is the real end game for the most talked about app in America? From one political statement shaking up a company's future, we now turn to just a few words from a government official that sent an entire market into a frenzy. $120 million. That's how much money was vaporized in just 1 hour on Friday. It was a massive, brutal squeeze for traders betting against the cryptocurrency Ether. To put a number like that in perspective, you have to understand the crypto derivatives market. It allows for extreme leverage, where traders can borrow up to 125 times their initial investment. This means a small price move against their bet can trigger an automatic forced liquidation. This creates a cascading effect, a feedback loop of buying that pushes the price up even faster and wipes out short positions in minutes. The situation presents a fascinating duality. On one side, traders were getting liquidated, while on the other, Ether itself was doing the exact opposite, smashing through its 2021 record, surging 15% to a new all-time high of over $4,800. So what lit the fuse on this explosion? The trigger came from a very unexpected source, Federal Reserve Chair Jerome Powell. During a speech, Powell hinted that interest rate cuts could be on the way. Now, this might seem disconnected, but the crypto market remains deeply intertwined with traditional finance. Research shows a strong correlation. When the Fed signals that money will be cheaper to borrow, investors tend to pour cash into what they see as higher risk, higher reward assets. And right now, crypto is at the top of that list. According to one crypto trading CEO, traders were, quote, caught completely offsides by the comments. He described the aftermath as a panicked repositioning, as shorts were squeezed and forced to buy back in, pushing the price even higher. This wasn't just about Ether. The shockwaves hit the whole market. Bitcoin jumped 4% to over $117,000. Crypto-focused companies like Bitmine Immersion and SharpLink Gaming saw their stocks leap by double digits, but not everyone was a winner. One company, ETHZilla, saw its stock plunge more than 31% on the same day. The reason for these wild stock swings is a new kind of business model. These companies follow a crypto treasury strategy, meaning they hold huge amounts of Ether directly on their balance sheets. Their stock essentially becomes a proxy for the crypto asset itself. So when Ether soars, their stock can fly. But as we saw with ETHZilla, it's a high volatility game and the crash can be just as brutal. This all points to a bigger story. Momentum is back. One top analyst from Fundstrat recently called stablecoins the ChatGPT moment for crypto. And his reasoning is pretty compelling. This isn't just hype. Stablecoins are digital tokens pegged to a stable asset, like the US dollar, and their use is exploding. The supply of stablecoins on the Ethereum network has already surpassed $140 billion. We are seeing a fundamental shift from pure speculation to real-world utility, making global payments faster and cheaper. He argues that what we're seeing now is the beginning of Wall Street running onto the blockchain, a move that could be the biggest macro trade for the next decade. And this isn't just a fantasy. A major driver is new legislation like the GENIUS Act, which creates a clear regulatory framework for these assets. This is giving big players like Bank of America and Citigroup the confidence to start building the bridges for Wall Street to move its operations on chain. The question is this a momentary surge or the start of a whole new game?
That's it for today on Voyage Daily Tech. Follow, share, and stay tuned for daily updates coming your way tomorrow.